Welcome in. Get started on today's video. Now, back in the day, and this goes back to maybe 2007 through 2010, I did daily videos at Investors Business Daily explaining the top performing CanSlim stocks to analyze. And it's funny because I stopped doing those 10 years ago, but people still remember them. And I'm going to continue to do some of those stock analysis videos here if and when it is relevant to the current market conditions. I find that some of these stock market updates, if they're not in the context of a broader investment philosophy, then they have a very short shelf life. I mean, who cares what Tesla stock did, its price or its earnings looked like in 2010, unless there is a valuable lesson beyond day trading that can help you manage your money and meet your financial goals. So what I've found in the past couple decades of teaching, trading, and managing investment portfolios for clients is that ultimately it's not about if you have a winning stock here or there. Honestly, that usually doesn't make much of a difference. The education I'm providing here is a little tougher to do than just saying, watch these trading signals, although, as I said, I will do that as part of the broader education, but I can't just leave it at that. I want you to understand how the most successful investors manage their money, and it is not by day trading. And by the way, I really have nothing against day trading, but it's not how you manage your retirement money, despite what you might hear on the internet, especially these days. A lot of that out there. You can definitely day trade as a business or to supplement your income, and I'm down with that. But showing how stocks trade can also have valuable lessons about overall market action. So I use them for those purposes too. Okay, so today I want to show you some ideas about diversified portfolios and how these can make a very, very big difference for your financial future. So let's take a look. All right, so we are looking here at a chart of the Dimensional Fund Advisors Global Allocation 60/40 portfolio. And let's break this down because this is a good starting point for how to diversify. And in this case, you can actually do a pretty good job diversifying with just this one fund right here, especially if you have a limited amount to invest, you can do that. Now, caveat, I am not recommending this, okay? I have no idea if this fund is appropriate for you, for your situation, but it is a good, simple illustration of asset allocation and diversification. Okay, so this fund, just like the name suggests here, holds 60% stocks. There's the 60. That's from all around the world, small companies, large companies. Also holds, right there, that 40% allocation in bonds. And yes, bonds are a very sleepy investment class that always takes a backseat to stocks in terms of what everybody wants to hear about. I mean, I know this for a fact because even when I'm in client meetings talking about their retirement, people tend to be more interested in the stock performance. It's all we hear about. And I get that. Bonds don't have the potential for that skyrocketing price appreciation the way growth stocks do, but they do serve a purpose to mitigate the volatility of stocks. That is why you own bonds. And here's why that is important. I'm going to show you this in just a minute. During times when the stock market is declining, bonds often, not always, but most of the time, bonds will rally when stocks are slumping. And that's a good lead-in to this next chart that I want to show you. So what you have here is a chart comparing 3 different mutual funds. And this goes back to January 2018. So pretty good representation of some downturns, some uptrends over the last couple of years. So right here is the fund I was just talking about, DG6, that DFA over here, the global allocation, 60% stocks, 40% bonds. Okay, and you notice it's right in the middle. Now, before I talk about that, we're comparing it here to 2 other funds. This one, VHGEX. That is the Vanguard Global Equity Fund. And again, that's exactly what it sounds like. It's global stocks. Okay. We're also comparing this on this chart with this TPINX here. That is the Templeton Global Bond Fund. Again, exactly what it sounds like. These are not performance numbers over here. This is just assuming all of these are indexed to 100 and what the current difference is right now, plus or minus that index level. Okay. So all of these funds, the DG6, let's start with that. It's the blended fund with the stocks and bonds. You see here, it's right in the middle, kind of most of the time. It's the black line here throughout this chart, if you can kind of see that. I wish I could make the colors a little different on this, but I can't. The black line running through there, you see this blended fund, 60-40 allocation kind of runs right down the middle. And that is exactly how you'd expect it to perform, the way it's designed to perform. There's actually zero surprises in this chart, which is why I wanted to show it to you. Okay, so up here is the Vanguard Equity Fund. Well. Lo and behold, most of the time here, it does have better performance. Oh, wait a minute. Until it doesn't. So how about that? Right back here when the market took a tumble back in March on the initial COVID-19 concerns, you saw that stocks tumbled, but oh my gosh, look at that. The bond fund held up better and the blended fund held up better. We also had a similar situation back at the end of 2018. That was so long ago, who remembers, because stocks have rallied back. But stocks ended 2018 poorly. And you do see back here, same exact thing. You have the stock fund is the worst performer of the three, with the blended fund being right in the middle. All right, that's exactly what you want. You know, people often complain that if you have a blended fund like this, an allocation, you're not going to get the best stock performance. I'm going to talk about that in just a few minutes. But you're also typically not going to get the worst. You're right down the middle. That is what you are trying to do, because I think historically, people tend to think about the stock market as growth, when you really want to shift that mindset and think about protecting your assets. Asset preservation is really as important as growth in most cases, especially if you're saving for retirement. So this is why you want the diversified portfolio. So to kind of follow up on the idea of the more aggressive portfolio, I can hear more aggressive investors among you thinking, well, why don't I just own that all stock portfolio? Because they eventually have higher performance and I can just sit it out through all the bad performance, right? Well, that is a very good question, which I have asked on your behalf, and I have heard clients ask that as well. Now, if you're young enough and you have no plans to use the money for a long time, retirement is not in your sights, then being more aggressive in your portfolio, perhaps if you're very young, and very few young people really do invest, but say you're 30 years old, just making that up as an age. In that case, it is kind of the tried and true advice for younger investors, and you might be able to get away with that for a while, but not indefinitely. It becomes more difficult when your main goal is retirement saving and you anticipate retiring within about the next 20 years or so. Because by that time, it does start to matter. And if there is a prolonged downturn, maybe lasting a year and a half, I mean, the technical definition of a bear market really is a year and a half, or you had some prolonged stock market malaise in the 1970s. That's not something that most of us right now have any memory or experience of. Then you have to think about, in that case, in a prolonged bear market, where are my retirement withdrawals coming from? Because people are going to be freaked out enough in a prolonged bear market. You don't want to have to worry about this as well. So do you want to, let's go back to this low point right here, okay? Let's say something like this lasts for a year and a half. Do you really want to be withdrawing from that stock fund at that point? When stocks are at their lows, you've not only done what's called locking in your losses, right? Because you've withdrawn at lows. You locked in that low price and you took your money. But now you have less available to help you regain when the market does go into rally mode again. So that's just going to make it much more difficult. But say you have a diversified portfolio, stocks are doing horrible, bonds are doing better. And in that case, well, look at this. What you could do is make withdrawals where I'm pointing right there. And this is just kind of theoretical. I'm telling you this just from the basis of asset allocation and how a professional money manager would think about this on your behalf, how you can be thinking about it too. But you'd want to be making withdrawals from the asset classes that are performing better and leave the other ones alone to, voila, build back up again, right? Now, again, that's a very, very simplified explanation of why asset allocation and broad diversification is desirable. But I think this does a good job of showing you why you need more than just stocks. Now, in a future video, I'm actually going to dive in a little deeper and show you why you have to diversify even more broadly with different types of stock and bond asset classes. Oh no, this isn't it. This is not the definitive portfolio here today, and please don't take it as such, just kind of showing you these for illustration purposes. Now, if you thought investing was easy, just buy some hot growth stocks, call it a day, no, it is not easy, but it is pretty simple. And we'll talk about that some more in a future video. That's all I got for you for today. Thanks for watching. If you have questions, feel free to reach out. Kate@katestalter.com. That's Kate@katestalter.com.